The tech and investment world woke up to a major shockwave in late trading. Alphabet's stock surged after a decisive federal court ruling in the United States, which had wide-ranging implications for Google's business operations, the search ecosystem, and the broader digital advertising market. The ruling came as a response to a lawsuit filed by the Department of Justice, DOJ, which had sought to force Google to split some of its core businesses, namely Chrome, Android, and its advertising infrastructure. For years, Google has faced scrutiny over alleged monopolistic practices in search and online advertising. The DOJ's case argued that Google's integrated ecosystem allowed it to maintain dominance in search and ads, potentially stifling competition and harming consumers. Investors feared that a breakup could force Google to divest Chrome, Android, or core ad products, potentially creating massive operational upheaval and hitting profits hard. The court's decision, however, delivered a clear reprieve for Google. The DOJ's request to split Chrome and Android was denied. While Google is required to share certain search data, which could gradually weaken its ad moat, the ruling allows the company to retain control of its core businesses, protecting both revenues and strategic growth plans. The market reacted almost immediately. Alphabet shares jumped 7% in after-hours trading, signaling relief for investors and validating confidence in Google's resilience. Analysts have noted that while this is a short-term win, long-term strategic vigilance is still needed as competition could gradually intensify, especially with new data-sharing obligations in place. In this video, we will unpack the full story: the court ruling, its implications for Google's search and ad businesses, how Apple and other partners are affected, potential risks in the coming years, and what investors should take away from this landmark moment. By the end, you'll understand why this decision is both a relief and a wake-up call for Alphabet, its partners, and the entire tech ecosystem. The first point to emphasize is the immediate market reaction. Google, officially Alphabet Inc., saw its stock jump 7% in after-hours trading following the announcement. Investors had feared a structural breakup that could impact revenue streams from Chrome, Android, and the ad ecosystem. Now that fear has been temporarily lifted. The federal court ruling stated that the DOJ's request to force a structural separation of Chrome and Android was unwarranted. This outcome means that Google can continue operating its key products without divesting them, maintaining the tight ecosystem that has been central to its competitive advantage. Chrome and Android are two of the most widely used platforms globally, with billions of active users and critical integration points for advertising and search revenue. While the court has sided with Google, it did not entirely absolve the company of regulatory oversight. Google will still be required to share certain search data with competitors, a move intended to increase market transparency and reduce potential anti-competitive behavior. Analysts argue that this data sharing requirement may have gradual effects on Google's ad dominance, but it is far less disruptive than a full structural breakup. For investors, this was a moment of relief. A forced split would have introduced enormous operational, technical, and financial challenges, and potentially triggered uncertainty across the broader tech market. The after-hours surge in stock prices demonstrates that the market interpreted the ruling as a clear, short-term win, reaffirming confidence in Google's resilience and strategy. Although Google avoided a forced breakup, the court imposed certain conditions that could influence its long-term strategic positioning. Chief among these is the requirement to share some search data with competitors. This provision is designed to level the playing field, giving rival search engines and platforms access to data that has been historically monopolized by Google. While this may not cause immediate disruptions, the implications could be substantial over time. Competitors gaining access to search data may start developing enhanced search algorithms, targeted advertising products, and niche platforms capable of eroding Google's market share. The court's ruling ensures short-term stability but introduces long-term competitive pressures. Furthermore, Google must comply with strict reporting and auditing protocols to ensure transparency in how search data is shared. While this doesn't dismantle Google's business model, it introduces administrative and compliance overhead, which could subtly affect operational efficiency. Market analysts have also noted the psychological impact. Competitors now have a roadmap to leverage previously restricted data, which could stimulate innovation in search, AI, and advertising. Consumers might not notice immediate changes, but the competitive landscape could shift over the next several years, particularly as rivals adapt faster and iterate on new ad strategies. For Google, balancing compliance with maintaining its profit margins and ecosystem cohesion will be critical. The company still commands massive traffic, massive ad revenue, and a loyal user base. However, regulatory scrutiny and the obligation to share data signal that while Google has won the battle today, the war for market dominance is far from over. An often overlooked angle in this story is the impact on Apple and other hardware partners. Apple receives roughly $20 billion annually from Google to keep Google as the default search engine on iPhones, iPads, and Mac devices. These revenue-sharing agreements have been a cornerstone of Apple's financial ecosystem, supplementing hardware sales with robust service income. The court ruling preserves these revenue-sharing arrangements, at least in the short term. By denying a structural breakup, the court effectively ensures that Google remains the default search provider on most devices, keeping Apple's payments intact. Hardware makers, including Samsung and other Android OEMs, also benefit from ecosystem stability. This is particularly relevant because these partners rely on predictable search and ad revenues for strategic planning, device launches, and service development. Any forced breakup could have disrupted multi-billion-dollar revenue streams, introducing market volatility and uncertainty. Investors and analysts agree that in the short term, the court ruling stabilizes the digital ecosystem, not just for Google, but for Apple and other strategic partners. The combination of steady search integration, predictable revenue, and ecosystem cohesion ensures that tech supply chains and service partnerships remain relatively insulated from immediate disruption. While today's news is a win for Google, there are several risks and challenges that remain. First, the data sharing requirement may gradually lower barriers for rivals. Competitors could leverage this data to improve search results, optimize ad targeting, or develop specialized platforms that chip away at Google's dominance. Second, the court's ruling does not prevent regulators from introducing future measures that could impact Google's ad revenue. For instance, European antitrust authorities and other federal agencies continue to monitor Google's practices. Global regulatory pressure remains a constant concern, particularly in privacy, data security, and competition. Third, the rise of alternative search platforms and AI-powered assistants could challenge Google's user base. As competitors gain access to search datasets, they may develop AI-enhanced experiences that attract niche audiences, reducing Google's market share over time. Additionally, consumer behavior is not static. New technologies, privacy concerns, and generational shifts could affect default search engine habits. Users may explore alternatives that comply with privacy-focused trends, further introducing market volatility. Finally, Google must manage its internal and external communications carefully. Employees, partners, and investors need clear guidance on strategic priorities, ensuring that market confidence and operational efficiency are maintained during this period of gradual competitive pressure. From an investor's perspective, the ruling presents a dual narrative, a short-term win and long-term caution. In the immediate aftermath, Alphabet's stock surge reflects relief that a forced breakup was avoided. Investors can breathe easy knowing that Chrome, Android, and Google Ads remain operational, supporting predictable cash flow and strategic growth. However, the long-term view requires vigilance. The court-mandated data sharing could empower competitors, gradually eroding Google's ad dominance. While Alphabet's technical infrastructure, AI capabilities, and brand strength remain unparalleled, market competition could intensify over the coming years. Financial analysts suggest that Alphabet is profitable but under watch. Stock prices may continue to rise in the short term, but investors should monitor regulatory developments, competitor activity, and user behavior trends. Strategic investments in AI, cloud services, and ecosystem expansion may offset competitive risks, but the moat is no longer impervious. In conclusion, the court ruling represents a strategic victory for Google, maintaining its integrated ecosystem and revenue streams while imposing regulatory oversight to ensure market fairness. For investors, it signals a bullish but cautious stance. The company remains strong today, but must navigate emerging competition and regulatory scrutiny carefully. Alphabet's ability to maintain dominance, innovate in AI, and adapt to changing market dynamics will determine whether today's victory translates into sustained, long-term growth.